Hello, today I want to talk about the CAPE ratio, the cyclically adjusted price to earnings ratio, otherwise known as the PE10 ratio or the Shiller CAPE ratio. Now, I have had previous talks on this discussion where I talk about what it is and I talk about criticisms of the ratio by others. You can check out those videos if you look at it here. But today I want to talk about why people are so comfortable with the current US CAPE ratio given that it is so high. So let's take a quick look at the CAPE ratio over time in the United States. We can see that it is currently very high. It was only higher during the internet bubble. And we know what happened after the internet bubble. We kind of see that here. These are valuation metrics. We can know what kind of happened with the stock price. I've also said that we really shouldn't be looking at PE ratios because it's not linear. It gets very distorted, especially as the ratios get high. We should be looking at earnings yield or earnings to price ratios. You can see my thoughts on these topics by following these videos here. We can also just go ahead and throw on this earnings to price ratio for the US, and you can definitely see that distortion. If you look at the internet bubble, it's not linear. The earnings to price ratio is, and you get this big distortion in the PE ratio. So let's go ahead and get rid of the PE ratio here. Look just at this earnings yield. And we can also add kind of average and standard deviation lines. We can see that the earnings yield in the US has only been lower again during the internet bubble, and it's now kind of one standard deviation below average. Now, when I question this with people, I get two kind of major comments. I get, well, Brian, look, interest rates are low, so it justifies low yields, or that the U.S. is somehow special, that it's developed, but it's growing, and it's somehow special, and that it demands, lower earnings yields than other parts of the world. So let's think about kind of that interest rate aspect there. I would argue that no, interest rates are low across the board. You can see federal or central bank actions here. Everyone's doing the same thing. Interest rates are very low. We can also kind of compare that to Europe, say, for example, which also has very, very low interest rates. They're basically the same as ours, but we can see that the earnings yields are different. We also know that there were times when Europe had lower interest rates, kind of post financial crisis, where they went negative. If you're going to follow this argument, you would argue then that Europe should have had even lower yields than the US did post financial crisis. That's not the case. We do see periods of time where, in the 80s, where, the US had a higher yield than Europe, so it's not consistent across time. Now, the other thing that people tell me is, well, the US is somehow special, like it should have lower yields. Well, let's compare it to Japan. We can see that's clearly not the case. Japan has had very, very low yields, much lower than the United States for much of its history. Currently, that's not the case. Japan has a higher yield and the US has a lower yield. All right, well, you're thinking, well, what about some other countries that are, similar to us? Well, Canada, again, here's another case in point where it has changed over time. Where there have been times when Canada has a higher yield, times when Canada has the lower yield. Does not appear to be something where we are somehow permanently different than another country. Now you're saying, well, Brian, you've compared it to two developed areas of the world. What if we compare it to emerging markets? Surely they're growing, and they would then have the same justification for very low yields now. Well, that turns out it's not the case either. So if we look at China and India, arguably growing much faster than the United States, have had times when the yields are lower. But again, now the US has much lower yields. It does not appear that there's something special, inherently special about the United States that would justify it having permanently low earnings yields. So next what I want to talk about is at various earnings yield, what kind of expected returns we've seen in the past. And we're going to find, as you think you can suspect, that these very low yields or these very high PE valuations do not bode well probabilistically for future returns. Thanks so much for listening. Look forward to that discussion.